Good evening and welcome to ATV. I'm Suad Asfour, your host. Today is March the 8th, and today is International Women's Day. So happy International Women's Day to all. And also we want to talk about another season. Today is tax season is here, and with it comes all the usual issues of paperwork and confusion. But this year might be especially difficult, as there are several new developments on the tax front. By learning about them beforehand, you will be better able to take steps that will leave you prepared both this year and next year. Tonight, we will discuss the biggest tax changes for the year 2015 and other important issues like how to avoid an IRS audit and what are the most dangerous mistakes people make and the consequences of not meeting your due diligence requirements. With that said, my guest tonight is Mr. Nawaf Shatrat, owner of Shatrat Accounting and Consulting in San Francisco Bay Area. Good evening, Mr. Shatrat, and welcome to the show.
Good evening. Thank you for having me.
You are very welcome. Thank you for driving all the way from San Francisco to be with us today. Nawaf, you graduated from the University of Miami, and you have 20 years of experience, correct, in this field?
Yes, I graduated from University of Miami. I've been doing this job over 20 years, yes.
Okay, and you have this accounting and consulting business. Can you tell us what you do in your company?
Well, after I worked for the Internal Revenue Service, which is the IRS.
So you are a former auditor?
Yes, I was an auditor with the IRS, and after I saw all the, let's say, the tax practitioners and the way they do things, I have decided to go on my own, and I have been on my own for almost over 15 years. What we do in my firm is we do complete accounting services, starting from bookkeeping, payroll taxes, sales taxes, income tax for individual and business, and also we do represent clients before government agencies.
Mm-hmm. Okay, great. So you covered the whole Bay Area, basically, or California, or everywhere?
Well, yeah, mostly,
pretty much.
Very much the Bay Area. In California, we deal with a client outside of the state.
Okay, so speaking of the IRS, and I'm sure there's rules, but there's also room for maneuver and to know more about when do we file our taxes and when is the deadline to file it, or the perfect date to file it.
Well, the due date for filing taxes usually is April the 15th.
Okay.
Now, if we are dealing with the calendar year, which end at the last day of the year, which is at 12/31, the due date will be April 15th. However, if people choose to go with the fiscal year, which is any month, which is the last day of the month, other than December, so they will have the 4 months and 15 days. Let's say that if you choose to the fiscal year as your year-end November 30th, so the due date for you will be March the 15th, which is the 15 days of the next 4 months.
The following 4 months.
Right. So this year...
So basically every quarter?
No. Usually it is
That's
the 15 days of the 4th month.
Okay.
So the fiscal year is different than the calendar year.
Okay.
Calendar year, it's the last day of the year. However, for the fiscal year, it is the last day for that month other than December.
So that varies depending on each personal situation.
Yes, but majority of people, they're not even aware of that fiscal situation or fiscal year situation, and they usually, generally speaking, the due date is April 15th.
Okay, so what about the people who cannot perform on time and they cannot file? How do they get extension?
Well, usually there's IRS will give you automatic extension for 6 months until
Without filing any forms or requests?
well, you have to request that automatic. Once you request it, IRS will grant it to you immediately. It's called automatic extension, and that if that will give you 6 months after the original due date. If the due date was April 15th, so you have until October 15th to file your income tax return.
So by filing late, does that increase the chances of getting audited by the IRS?
Well, that's really misconceptions with a lot of people think, oh, I don't want to file an extension. The extension is you're right, the IRS giving it to you. Now, a lot of reasons people really don't have their taxes ready to be filed for different reasons. Some of them lazy. Even if you give them extensions for life, they will take it.
They will still need more time.
Yeah, but however, there are some extenuating circumstances for other, which is they could not prepare their taxes on time. Okay, some family issues, traveling issue, and so on and so forth. However, there is what we need to understand. The extension is to file, not to pay. So the payment is due on April 15th.
Okay.
So
would they get fine or late fees if they don't make the payment, and late fees for not filing on time?
Well, if you get the extension, there is two penalties involved in this situation. The first one is failure to file and failure to pay.
To pay.
So if you file an extension, so that will give you automatic extension until October 15, you already satisfy the filing requirement. Now, the payment, all those things, all the amount must be paid on time. Now, if it's not made on time, then there is interest,
penalties.
accrue.
Okay, so I understand that there is misconception that people think that if they don't file on time, they might be audited, which we don't have to worry about that.
That's absolutely the case. You know, this is a lot of, if you think millions of people file extensions, you know, and this is even, I was reading something, even extension maybe will decrease your chances of being audited.
Wow, that's good news.
Well, don't take me that. I was reading that. I don't know how factual it is.
Because they'll be so busy doing all the priority that comes in first come, first serve.
Right. And, you know, for people, the good news, which is IRS, the people who get audited by the IRS is less than 1%.
Oh.
So unless if people really doing some crazy stuff on their tax return, their chances is really very minimal.
Well, since you are a former auditor for the IRS, what do they look for? What is it something we need to watch out for so we'll never get audited?
Well, you know, there's always the IRS come up with different technique in choosing an audit, but really what's the most important thing for people to understand,
maybe to make everything looks more realistic.
It's just really look at the picture's common sense. Is really does this tax return make sense when you look at it? The problem, a lot of people are just really, they make very obvious mistakes, which is anybody could pick as an issue. For example, somebody who has a mortgage interest plus property taxes, which is equivalent to $50,000, which has only those very obvious and has been reported to the IRS. And when you look at their income is $30,000. Now the questions comes to play.
That raises red flag.
If only your mortgage interest and property taxes is $50,000 and your income is $30,000, how do you support your lifestyle before eating, before driving, before, you know, all of those things? So these things people have to understand. Unless you know, there is a substantiation for your record on your tax return, then you have to be very careful. Other issue with people, they really put a huge amount on their tax return. For example, you know, you don't make enough money, just, or barely you're making money just to support your family. And then when you look at all these deductions, for example, they put a huge number. And those numbers is just...
It doesn't work out, doesn't
Right.
balance itself out.
Right.
So basically, honesty is the best policy, is to stay honest on the books.
That's
And records.
absolutely. Honesty is your best bet, because if you're honest, you'll have all document to support your argument. However, which is one very important thing, and I have seen these things with a lot of people now, underreporting, which means that
They hide.
all your income has not been reported.
Okay, so they hide.
Well, let's not use the word hide intentionally. There is something people, they're not really not aware of how those
Oh,
taxes
okay.
work, or maybe they're relying on somebody who is not expert on the field, just count you as a number, not taking the time and explain to you and taking the information from you and prepare the tax return accurately. So that problem caused a lot of people to be audited. Now, especially what we have regarding the 1099. Now, everything, or most of the things that we see these days, it's electronically being reported to the IRS. Now, even credit card merchants, the company or the bank has to issue what they call a 1099-K. It will show how much a credit card collected from sales to customer.
Right.
Now, IRS will have an idea exactly. Now, let's say that if your credit card sales is $300,000, and then you're only reporting gross sales of $250,000, it's very obvious that underreporting.
Something is not right.
Right. So what I am telling people, collect all your information. Rely on somebody with knowledge and expertise. And always keep adequate books and record for your situation.
Excellent. So what are the most dangerous mistakes people make, beside what you mentioned?
Well,
Everything.
the most dangerous things is just careless, and also honesty issue.
Okay.
Some of them, they say, okay, well, there's what they call shopping around. You know, we always have kind of views, okay, well, how much can I get me refund? And so much you gonna get me refund. So that's what they call shopping around for that. And the most important thing is just to be honest on that.
What are the 4 due diligence requirements?
Well, there is a due diligence if you are talking to me about the earned income credit.
Okay.
Let me explain what is the earned income credit.
Okay.
Income credit, it's a refundable tax credit, even though you have not contributed to the system. Let me explain. You know, sometimes when you work as an employee, you will get a W-2. Now there is a federal withholding on your W-2. That's your contribution. Now, for somebody who qualifies for the earned income credit, they will get that taxable refund even though they have not contributed to the system. Now, IRS really going hard on people with the earned income credit. One of the things they have, there is a special department within the IRS called, or specialized in the earned income credit. Now, the IRS in the past 3 years have really gone hard on preparers and on taxpayers. Now, as a preparer, you have to do your due diligence in order to make sure that all the information that the taxpayer giving you makes sense, is inaccurate. There is a form called 8867, which is you have to interview the taxpayer, make sure that all the information is provided to you. Now, take documentation to show that he does qualify for the earned income credit and submit those documentation. Now, failing to do that will have the IRS go after you and penalize you. And $500 for each return, and the minimum is 25 returns. So the minimum it will be $12,500.
Wow.
They could go that. Now for the taxpayer, you know, make sure that really you're being honest in order to qualify for the earned income credit. Failing to do that, they will ban you for 2 years from claiming the earned income credit.
Wow.
Now, if there is a fraud, they could ban you for 10 years from claiming the credit card, from the earned income credit. So those things, a lot of people, they are not aware of it, because one of the things which is, as a CPA, and when I have a client with earned income credit, I ask them, where does your children live? If his children live outside the United States, they will disqualify immediately. What I mean about living outside the United States, if they live more than 6 months outside of the United States in that tax
period.
Yes, for example, for 2000. And now if he told me, yes, they live here, and said, okay, well, do they go to school? If they are old enough to go to school? If they yes, then could you show me some documentation to show they are going to school? Now, if they don't go to school because of their age, well, do they go to the doctor, show me something? Okay? And then also you have to look into the income. And this is certain, you know, steps that has to be followed by the tax practitioner. And then you have to show that you have done your due diligence. And that has to be documented for the income credit. And people has to be very, very careful, because if they ban you for 10 years from claiming your earned income credit, how long are you going to claim your earned income credit? Because the kid's going to be very old, and technically speaking, it's gone.
Oh my God, that's not very fun consequences. So it's best to just actually do everything right and work with the tax man or tax person that does everything right.
The right tax man.
Okay, what about entities, tax entities for, let's say, maybe corporation, or what's the choices?
Well, there is certain choices people can make when it comes to business entities. Now, what I mean about business entities, we're talking about partnership, corporation, whether it's a C or an S corporation, and LLC, which is a limited liability companies. Now, each entities has advantage and disadvantage. Now, a lot of people, they go ahead and form their entities, or they choose their entities without really talking to a good tax accounting for the consulting, and to explain to them really what is the advantage and disadvantage of these entities. I hear a lot of say, okay, why, for example, why did you choose to become LLC? Oh, because so-and-so chose LLC. So there is really, don't understand exactly why they choose it. So for example, there are certain entities which is recognized by the state, however, the federal government does not recognize it. For example, limited liability company, which is an LLC, it's only recognized by the state. There is no such thing within the federal government called LLC. So if you choose an LLC, make sure why you chose it, understand why you chose it, and then what you need to understand, this is only will apply to state rules. what are you going to choose for federal filing? The only things is recognized by the IRS for that purpose: corporation, partnership, or sole proprietor. So these things is very important to talk to somebody and understand the advantage and the disadvantage of these entities.
So it is our duty to understand all that stuff. For an average person, that's a lot of material to observe.
Of course, you know, if you're going to be a CEO, because usually who runs these kind of entities? Somebody who has to be knowledgeable about, you know, understand the rules and regulations, and there is legal counsel that he can advise you in legality, and there is a CPA who could tell you what the consequences about taxes and advantage and disadvantage about choosing these entities. So people has to do their homework before making that.
And it's worth it to pay the fee to get a legal advice if they have to.
Absolutely, and make sure, and this is what advice, because, you know, attorneys, they can speak from a legal point of view. CPA, they can talk from accounting and tax point of view.
Okay.
Okay, that's very important. And what I have seen so far regarding those kind of entities, people goes online. So okay, for example, different vendors there, they go ahead and form a corporation. And we ask them, I said, okay, well, did you file a corporation? Yes. Is it S corporation? Yes. No, it's not an S corporation. Why? Did you file a form, what they call 2553, with the IRS, electing to be treated as an S corporation? So when you file that and you're telling the IRS you are an S corporation and you have not filed that election, which will, you know, give you a problem down the road. So it is very important exactly to follow all the steps necessary to ensure that you are following the rules and regulations. And the other things, which is people think business entity, I'm talking about, for example, S corporation, which is the most common, which is called subchapter S, which is the S corporation. Even though you own that corporation, it is a separate entity. It is a distinct entity, which means if you are going to work for that entity, you have to be compensated reasonably for the work you do for that corporation. And there is a line 7 on 1120S, and the federal corporation said, okay, well, there is an officer compensation. So the reason for that, because these when you have a payroll or whatever, then there is a self-employment taxes involved, because if you check the W-2, there is on line 4, which is Social Security, and line 6, Medicare. Those are what they call self-employment taxes. So the employer contribute half, and they withheld from the employee the other half. So once you have a payroll, then that will satisfy it. Why? Because the net income from the S corporation, it is not subject to the self-employment taxes. It is an ordinary income. So people trying to escape from that, IRS will get you, because line 7, and it has to be reasonably compensated for the work to do.
With the last 2 minutes we have, I wanted to ask important question about how does married people are affected by filing separately or jointly?
Well, regarding married filing jointly, people, if they have itemized deduction, higher itemized deduction, higher contribution, and they have higher income, sometimes they think that it's better for them to file married filing separately. Now, understand that if you are filing married jointly, it is the responsibilities of both spouses for filing the joint return. Now, the issue with the married filing separately, because if one spouse itemize, the other spouse must itemize. So it's really, generally speaking, it's always better off with the married filing jointly. However, it's always saying it's based on the facts, based on the circumstances. So technically speaking, we have to find out, and we will be able to determine which better for the taxpayers, married filing jointly or married filing separately.
Great. Now we need the final advice from you and what you're telling everybody, since we're still in March, and this is the time to pay attention.
This is my advice to people. I've been, working in this business for a long time. Always, my advice to you: keep adequate books and record. Rely on somebody who is knowledgeable, somebody who is willing to take the time with you and educate you, if you are willing to be educated. And also, the most important thing, be honest when it comes to your tax return.
Beautiful. Thank you so much for all these advices, and good luck on this busy season of yours. And I like to also remind people that when in doubt about the best time to file your tax, talk to a tax advisor. Thank you for watching us. We'll see you next time. Good night.
Thank you.
Thank you. Thank you for coming.